Today, we're diving into the accounting cycle. But look, instead of getting bogged down in confusing jargon, we're going to do something different. We're going to follow the story of a brand new business from day one to see how the money really moves.
So let's follow our guy, Jim. We're going to track his very first month in business, watching him turn this dream of opening a little shop into a real financial reality.
And I are going to learn the language his business speaks, which is, of course, the universal language of accounting.
So, here's our game plan. We're going to follow the entire accounting cycle from start to finish. We'll start with Jim's big idea and end with his business totally prepped and ready for its second month.
And here's what he's working with. $4,000. His own cash. He's going to open a shop selling Pokemon balls. And you and we're going to follow every single dollar to see if he can actually make this work.
All right, let's jump in. It's December 1st, Jim's first day, and he's got a few really important things to do right off the bat to get this whole thing set up correctly.
First things first, he takes his personal $4,000 and officially puts it into the business. This is so important. It creates a clean line between his money and the company's money. This is now the business's starting capital, or what accountants call owner's equity. It's basically his stake in the game.
So, in the books, it looks like this. We debit the cash account to show it's increased by $4,000. And at the exact same time, we credit his capital account. You see? Every action has an equal and opposite reaction. That's the whole idea behind double entry accounting, and it's what keeps everything perfectly in balance right from the start.
You know, his first month was just an absolute whirlwind. He put his capital in, he bought all his inventory, he made his very first sale, and even got a loan to grow faster. Every single one of these moments is a crucial piece to the financial puzzle we're about to put together.
So, how in the world does Jim keep track of all this stuff? Well, every transaction, I mean everything, from buying a desk to making a huge sale, it all gets written down in the business's financial diary. And we do this using what are called journal entries.
Okay, cash in the bank. Time to go shopping. Jim gets to work. He spends $80 on rent, $580 on some furniture and a laptop, and then he makes his first big move, $2,000 for 1,000 Pokeballs. He's got to have something to sell, right? And here's what that looks like in the records. See the pattern? The cash account goes down, but something else always goes up. He's just trading cash for other things the business now has, like inventory or equipment. That fundamental equation, it's always balanced.
With the shop all set up and stocked, Jim flips the sign to open. And this is where the real action begins.
And boom, just a few days in, it happens. His first big sale. A customer walks in and buys 500 Pokeballs, paying him $1,500 in cash. This is the moment every new business owner dreams about. Now, this is really important, so follow me here. A sale isn't just one thing, it's two. First, we record the cash coming in. That's the revenue. But we also have to record that $1,000 worth of inventory just walked out the door. So we move that cost from our inventory asset account over to an expense called cost of goods sold. Makes sense, right?
Jim's feeling ambitious. He sees things are working, and he wants to grow faster. So he gets a $2,000 loan for some extra cash. Then he orders more inventory, but this time he buys it on account, which means his supplier is letting him pay later.
And this brings up a really crucial difference. When you pay with cash, it's simple. Cash goes down, done. But when you buy on account, you get the stuff now, but you create a debt, a liability. It's basically an IOU called accounts payable. You've promised to pay that money later.
Welcome to the store. We have all the rarest finds today.
Look, a great ball. I've always wanted one.
Here you go.
And then things really start happening. He makes his first cash sale. Boom, cash comes in, and we record the sales revenue. But check this out. For every sale, there's a second entry for cost of goods sold. This is so important because it moves the cost of the inventory he just sold from being an asset to being an expense. That's how we'll figure out his actual profit later. He also gets a loan and then lands a big sale on credit. This creates an accounts receivable, which is just a fancy way of saying money that customers owe me. Okay, as we get to the end of the month, the fun of making sales gives way to, well, the less glamorous part of the job, paying all the bills and making sure the books are 100% accurate.
And the reality of running a business kicks in. You've got all these little costs that add up. The light bill, a salary for himself, taxes, you know the drill. All told, another $430 goes out the door in cash.
All right, time to manage the debts. Jim pays back $200 of his loan plus $80 in interest. He also pays his supplier $1,000 of what he owes them. And at the same time, a customer who owed him money pays him $1,000. Whew, it's just a flurry of cash moving in and out.
One last thing. That furniture and laptop he bought, they got a month older, a little more used. We have to account for that wear and tear. Even though no cash leaves his hands for this, it's a real expense, and it's called depreciation. For his stuff, we figure it's about $16 for the month. Okay, wow, we've just recorded a ton of debits and credits. With all these numbers flying around, how do we know for sure we didn't mess up somewhere? We really need a way to hit pause and just check our work before we go any further.
And that's a really important question, right? I mean, one little typo could throw this whole thing completely off. Luckily, the answer is a simple but really powerful tool that's basically our first big checkpoint.
What we do is create something called a trial balance. Just think of it like a master list of every single account and what its final balance is. We just add up all the debits into one column and all the credits into another. The goal? It's simple. Prove that those two columns are perfectly equal.
And there you have it. The key thing here is that the total debits perfectly match the total credits. Both columns add up to exactly $11,316.11. This is our green light. It tells us we're good to go and can move on to the main event.
Confident our numbers are solid, we can finally take all that organized data and build the 3 big reports that are going to tell the real story of how Jim's business actually did in December.
First things first, we've got to calculate the number every business owner wants to know: net income. You've heard it called the bottom line. It's the ultimate scorecard for the month.
We figure that out with the income statement. We take his total sales, which was $4,500, subtract the cost of the actual products he sold, and then we subtract every other expense he had for the month.
And there it is, the big reveal, the climax of the story. After everything was said and done, Jim's little shop made a profit of $893.89 in its very first month. I mean, that's a fantastic start.
So what happens to that profit? Well, next we have to see how it affects Jim's personal stake in his business. The statement of owner's equity is super simple. It just shows that his initial $4,000 investment has now grown by the amount of profit he just made.
Now this brings us to probably the most fundamental idea in all of accounting, and it's the bedrock for our final report. The balance sheet is built on this really simple, powerful equation. Everything the business owns has to equal what it owes, whether it's owed to other people, like a bank, or to the owner himself.
And here it is, the balance sheet. It's like a financial snapshot of the business on the very last day of the month. On the left, we list everything it owns, its assets. On the right, everything it owes, its liabilities and equity. And look at that. The two sides match perfectly, down to the last penny. This is the ultimate proof that our accounting is solid. Okay, so the story of December has been told. The reports are done. Now it's time for the very last step in the cycle. We gotta wipe the slate clean so we can start totally fresh for January.
We do this with a process called closing entries. And the goals are really straightforward. First, you zero out all the temporary accounts. That's all your revenues and expenses. Then you officially transfer that net income we calculated right into the owner's permanent capital account.
And for our grand finale, we run one last trial balance, but this one's called the post-closing trial balance. It only has the permanent accounts left on it. You know, assets, liabilities, and Jim's brand new updated capital balance. And what do you know? It balances perfectly. This is our final confirmation that we are officially ready to start the cycle all over again for January. And that, my friends, is the entire accounting cycle in action. We went from a single purchase all the way to the final polished reports. We proved that Jim's business is profitable, which is a massive win. But as we look ahead, what's his biggest challenge for January going to be? With a loan to pay back and customers to collect from, the next chapter of his financial story is really just beginning.